If you're the kind of person who brags to your friends when you overpay for your favorite stuff, then this is a great market for you. Is that confusing? It should be confusing to you. Guys, years ago, I remember I was looking at this investment and I was talking to a friend of mine who was just got done bragging about the deal he got in a car. He saved $1,000 in a car. He was so excited about it. But then he went and bought the stock. And I go, why'd you buy that stock? He's like, well, look at it recently. It's up so much. And I'm like, wait, what? I don't understand this. Daniel, my future stepson, I used to teach him, I used to tutor him in school. And one time he was in school, he heard me talk about investments. He was 12 years old. And I talked about how much I like it when stocks are down. And he was a little confused by that, but he finally bought into it. So one day he's at school and he came home that day. I had dinner with him that night. He said, Paul, at school, my teacher was talking about how stocks being down is bad. And I raised my hand saying, I thought we want to get a good price on things. We want to buy stocks when they're cheaper. I swear to you, this happened to a 12-year-old.
Did her brain melt?
Her brain did melt. And that's the point. So guys, if that melted your brain, understood. It used to melt my brain too. You just need to stick with it. It'll be a lot easier. And trust me when I say, once you understand this concept, you will be able to make amazing returns, because being in the market is simple, but it's not easy. The hard part is temperament. So when you see stocks going down, it's hard to flip yourself into the same mode you have when you see your favorite clothing going down in price or see your favorite car going down in price. If I told you right now that you could buy a Ferrari for $20,000, would you say, no, I can't do that because it fell from $300,000 to $20,000? No, you'd be like, I'm going to get $20,000 right now.
Yeah, I'm going to go do whatever I can to get 20 grand.
This iPhone was $1,400. If I could buy this thing today for $400, would I do it? Absolutely. Would I care that I paid $1,400 for this one? No, I'd want more of it. I'd go buy some more of it. And that's the key here. So this is a big myth that we're trying to bust here. People think that stocks going down is a bad thing. Why? Why do people think it's a bad thing, Mo?
Because you're losing money. It can go to zero. The company's getting bad.
That's what they say.
That's the excuse.
What's the reality?
The reality. The reality is you are more likely than not often overpaying for a company. And at some point, the price and the fundamentals of the company are going to match up, and you're going to be buying a great company for a great price.
And at some point, if it keeps going, the price will fall below the long-term value.
You'll be able to buy your dollar for 75 cents, and then it'll make itself back up.
Is it possible that a company goes to zero? Absolutely. Look at Carvana. It has fallen 99% in the last 15, 18 months, and they're talking about bankruptcy. But look at the market overall. What would it take for the stock market overall to go to zero? And remember, in 2006, I was helping friends with their savings. And I said to them, if stocks fell in half, what would you do? And the wife looked at me and said, well, we buy more, right? Exactly. 1 year later, when stocks were down 30%, she literally wrote me an email saying, I've sold everything because I'm worried about stocks going to zero. I wrote back, I said, if stocks go to zero, you're not going to care that you have $0 in savings. There's going to be such complete Armageddon, it will not matter. And look at history.
That means a lot of businesses don't exist anymore.
Correct.
There's major issues out there.
Look at history. You know, I like this site sometimes, and it shows.
Look at stocks going down and being 40% off as Black Friday sales. I mean, it's an extended Black Friday sale. That's really what it is.
This is the S&P 500 by month. Just look at it back in history. In all this time, look at how far. 2013, it was 1,600. 2009, it was 1,000. 2000, it was 1,460. 1995, it was 481. We go back all the way down to 1900. The S&P equivalent was 6. In that time, we've had presidential assassinations. We have 2 world wars. We've had terrorist attacks. We've had every possible bad thing in the world that could possibly happen. And it was 6 in 1900. 6.
And by the way,
that doesn't include dividends.
It's not different this time.
It's not different this time.
That's the thing. People are going to say, well, it went from 6 to whatever it's at today, but now it's different because it's a different world.
Nope, it's not.
It's the same game, and there's just different players playing in it.
So $1 of cash flow is still $1 of cash flow, whether it was in 1900 or, and that dollar can buy more. But the point is, on a return on investment, it's still the same percentages. And that's the key here. You want stocks to go down, especially if you're a long-term investor. Now, if you're close to retirement, I get it. You don't want stocks to go down. But then you need to reassess where you are in your retirement accounts. Where do you stand currently? You shouldn't have a ton of money in something that can fluctuate this much. But if you're a long-term person, you have decades until you retire, you absolutely want stocks to go down. You're buying great companies at much better prices. If you like the S&P at 4,800, why would you not love it at 2,400? That doesn't make any sense to me. That's literally like saying, I love this phone at 1,400, but now there's a sale at 700. I'm going to regret buying. No, go buy some more. Go buy some more. Because look at the chart of SPY. Let's pull it up in our software. You're not even going to notice the difference in the pricing of this ETF. This goes back to 1993. What do you see here? Yes, you see ups and downs, but what do you see overall? And even if it goes to 2,400, that's like right here. That's like right here. It's still a lot of growth. And if you bought all along the way here, you got compounded and compounded and compounded growth. You need to reprogram yourself into getting excited when stocks go down. You know what I did in our office? I used to do it where whenever the stock market was down 1% for the day, everybody got free lunch the next day. It was kind of a way to get everybody excited about stocks going down. It's absolutely the best thing. Go ahead, Mo.
I also think it's important to point out that everything goes on average. So let's say it goes like this. This was crazy. Let's say that stocks drop below 2,400 and it comes down here. Guys, it's going to come back up here. Don't worry. Yep. In the long term, you're going to be back on this line. Don't fear. As crazy as this was, this is crazy too. Okay? Everything that works on averages in the market.
And I've shown this chart 1,000 times. This is where stocks go as their value, but this is where the prices go. It's still increasing, but it goes up and down. And you just want to buy all along the way. All along the way.
Yeah.
You're going to overpay sometimes. You're going to underpay sometimes. But over a long period of time, you do this. Now, this is for dollar cost averaging, but the same for ETFs. But the same applies on individual stocks. If you want 20% of your portfolio to be in individual stocks, subscribe to the channel. We talk about individual stocks and the process to buy them. But the same thing should apply. I ask 3 questions whenever I want to buy an individual stock. 1, do I think it's going to be around for 10 years or the foreseeable future? If the answer is yes, I go to the next question. Do I think it'll make more revenue and more profit in that foreseeable future than it is today? If the answer to that is yes, my third and most important question is, can I pay a reasonable price today to get me a reasonable return on that future potential growth? That's the hardest one because it's hard to find those in an overpriced market, but there'll be a time when that's a lot easier. And you're going to want stocks to go down in order for that third question to end up being a yes. That's the hardest one to get a yes to. And in that time period, you need to be patient. Go look at my watch list on our software. I have 109 stocks. Pardon me. I have 109 stocks on my watch list right now, waiting for them to hit the price that either I want to buy them at, or I want to start selling puts at lower prices, start buying them at much lower prices, being paid to wait. And these are all things that we teach on this channel. Yep. So Mo, when he is investing, if he doesn't have money to invest in, he does charts.
Yeah.
I do the same thing, but my money's kind of right now going to a new house. But when I have excess cash after the house is done, I will do long-term and swing trading.
And guys, I pulled up an awesome example here. This is a long-term chart. This is Zim. So this is the shipping company. Now, if I told
Didn't you have a short on this for a while?
I did. I mean, and look at back here in April. Back here, this was April of 2020. What year is this? 22? 22. I mean, look at this fall. Guys, there's a great opportunity that you can have in here with this trend. It just stayed below this 32% line. As long as you're in a stock and it's below this 32% line, you're good. You could stay short in this thing. And look at how long this thing has gone. This has gone months and months and months.
What was the first signal? The first signal was back in...
First signal was back in April. This is where I was in Mexico.
But you wouldn't have shorted then, though.
Let's see here. Give me 1 second.
Because look at the stochastic.
Nope, I'm wrong. It was right here.
Oh.
It was right.
Oh, yeah, because it dipped right into the...
It was April 4th. That's what it was. It was April 4th.
Now, so here's the reason why, guys. Look below it is stochastic lines. The red and yellow fell underneath.
So this horizontal line here and this horizontal line here, this is what I call the sweet spot. Okay, I'll just write SS. That's my sweet spot. When you're in there, you have the highest probability of making money, and this is to the downside. And as soon as you enter that sweet spot with your red and your yellow line, when you get an engulfing candlestick, meaning that there's a lot of selling volume coming in that day, you just let this thing ride and just stay in it. You stay in it, stay in it, stay in it, stay in it. Guys, this is a great way to make money on the downside. This is why I get excited when stocks fall. It's yes, I'm going to be able to buy value plays, but I really love being able to short stocks. And it's so fun to sit in a stock for multiple months and make money. Guys, I teach trading in the oracles of EM. If you guys want to come in, $79 a month, completely risk-free. Try it for a month. I challenge you to that. Try it for a month. Give me 30 minutes a day watching the training videos. Go ahead and watch some options videos. 30 minutes out of your day. You spend more time doing that on Instagram and Facebook. Give me 30 days. You'll be better for it.
All right, guys. So thanks very much. If you like it, subscribe to the channel. Check us out at everythingmoney.com. Appreciate your time. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?